Breaking news this morning, look out below. Take a look at U.S. stock futures. All markets on edge and dropping. These futures just took a notable turn downward again.
April 2nd, 2025. A date that may not be etched in history books for a battle or a treaty, but for a seismic shift in North American energy dynamics. On this day, a pipeline deep within the forests of British Columbia began transporting oil not southward to the United States, as it had for decades, but westward to the Pacific, marking a pivotal turn in Canada's energy strategy. For years, Canada had been a steadfast supplier of oil to the U.S., often at discounted rates. However, mounting frustrations over trade disputes and perceived economic subordination led Canada to reevaluate its position. The culmination of these tensions was catalyzed by the entry of China's Rongsheng petrochemical into Canada's energy sector. This Chinese energy giant secured agreements to purchase 800,000 barrels per day of Canadian crude, redirecting a significant portion of North America's energy supply directly to Asia. This development wasn't merely about oil shipments, it signified a profound shift in geopolitical alliances and economic dependencies. The United States, once the primary beneficiary of Canadian energy exports, found itself sidelined. The implications were vast: diminished energy security, economic instability, and a waning influence on the global stage. In an attempt to assert economic dominance and address trade imbalances, President Donald Trump imposed a 10% tariff on Canadian oil imports. The expectation was that Canada, heavily reliant on the U.S. market, would acquiesce to American demands. However, this move proved to be a strategic miscalculation. Canadian Prime Minister Mark Carney, leveraging his background in finance and economics, stood firm against U.S. pressure. Recognizing the opportunity to diversify Canada's energy export markets, Carney facilitated accelerated negotiations with Asian nations. Major Canadian energy companies, Suncor, Cenovus, and Canadian Natural Resources, swiftly redirected their crude exports towards China, India, and Japan. Unlike American buyers, who often entangled oil purchases with political considerations, Asian markets presented straightforward propositions. They were willing to pay premium prices for reliable energy supplies. This shift not only provided Canada with better financial returns, but also reduced its economic dependence on the United States. China's strategy to secure energy resources extended beyond purchasing oil. Rongsheng Petrochemical established a significant presence in Calgary, embedding itself within Canada's energy infrastructure. Through strategic investments and partnerships, Rongsheng aimed to control a substantial portion of the Trans Mountain Pipeline's capacity, targeting 10% ownership by 2026. Historically, U.S. refiners benefited from Canadian oil sold at prices $10 to $15 per barrel lower than global benchmarks. This discount was largely due to Canada's limited export infrastructure, which constrained its market reach. However, the completion of the Trans Mountain Expansion project in May 2024 transformed this dynamic. The expansion tripled the pipeline's capacity to 890,000 barrels per day, facilitating direct access to Asian markets. Early shipments reached South Korea, with subsequent exports to Japan and India. As a result, Canadian crude became a globally traded commodity, subject to competitive bidding. For U.S. refiners, this development meant the end of preferential pricing. They now faced global market rates and increased competition from Asian buyers. Canada's energy transformation wasn't limited to oil. The country made significant strides in the liquefied natural gas, LNG sector. LNG Canada, a $40 billion project led by Shell and PetroChina, commenced operations in mid-2025, exporting 14 million tons of LNG annually directly to Asia. This facility, located in Kitimat, British Columbia, marked Canada's entry into the global LNG market, traditionally dominated by Qatar and Russia. By bypassing U.S. infrastructure, Canada positioned itself as a stable and neutral energy supplier to the Indo-Pacific region. Prime Minister Carney had been laying the groundwork for this venture since 2023, investing $6.5 billion to penetrate Asian markets. The repercussions of Canada's energy redirection extended to electricity. By early 2026, the U.S. experienced rolling blackouts in states like Michigan, New York, and California. The primary cause was Canada's decision to reduce hydroelectric power exports. Hydro-Quebec and Ontario Power Generation, which had supplied 42 terawatt-hours of electricity to the U.S. in 2024, reallocated their output to domestic needs and Asian markets. Officially termed a supply reallocation, this move was widely interpreted as a response to U.S. tariffs and trade policies. The sudden shortfall strained U.S. power grids, leading to increased reliance on gas peaker plants and exposing vulnerabilities in aging infrastructure. Major cities faced power outages, disrupting industries and daily life. Amid the crisis, President Trump focused on unrelated issues, drawing criticism for his handling of the situation. In a high-profile press conference in Calgary, Rongsheng Petrochemical announced its control over 10% of the Trans Mountain Pipeline's capacity, equating to 89,000 barrels per day. The significance of this declaration lay in the FOB terms, granting Rongsheng the authority to direct oil shipments to markets offering the highest returns. This strategic positioning underscored a broader shift in global energy dynamics. Analysts viewed it as the end of U.S. energy primacy, with China solidifying its influence over North American energy resources. The U.S. government labeled Rongsheng's actions as a strategic threat, while financial markets adjusted to the new reality. Canadian officials embraced the change, with the energy minister referring to it as the post-American era, and Alberta's premier highlighting it as economic sovereignty in action. In a bid to reassert control, President Trump escalated the trade conflict by imposing a 25% tariff on Canadian oil, gas, and electric vehicles. Canada's response was swift and decisive. It halted all eastbound oil shipments to the U.S., effectively cutting off supply to refineries in Maine, New Jersey, and South Carolina. The immediate consequences were severe. Gasoline prices soared, airlines reduced flights, and manufacturing plants faced shutdowns due to energy shortages. Amid escalating tensions, a Trump advisor suggested the annexation of Canada as a solution to the trade impasse. The proposal was met with international condemnation. Canadian Prime Minister Carney firmly rejected the notion, stating, "Canada is not for sale." Global leaders criticized the idea as economic imperialism, leading to a decline in investor confidence and a sharp drop in the U.S. dollar's value. Even NATO allies began questioning the stability of the U.S. government, highlighting the far-reaching implications of the trade dispute. The trade war between the United States and Canada didn't just hit oil and gas, it sent shockwaves through the automotive industry too, and no company felt the blow harder than Tesla. Once a darling of Canadian eco-conscious consumers, Tesla was aggressively expanding its presence in the country. The company had just opened its third gigafactory in North America and was banking on Canada's generous electric vehicle subsidies to fuel its sales. But then came the tariffs and the retaliation. In a swift and unflinching response, the Canadian government revoked all federal EV subsidies for Tesla, a move that immediately wiped out nearly $43 million in projected incentives the company had counted on for the year. Provincial programs followed suit, with Ontario and Quebec removing Tesla from their preferred manufacturer lists. Almost overnight, Tesla became non-competitive in a market where it had previously thrived. Consumers, once eager to get behind the wheel of a Model 3 or Model Y with thousands in rebates, began turning to domestic alternatives. Canadian automakers, buoyed by government incentives and a surge in national pride, saw their EV sales surge as Teslas fell off a cliff. Investors panicked. Tesla's stock took a sharp double-digit plunge in just a few days, and analysts began slashing forecasts for international revenue growth. Elon Musk, in a rare moment of public frustration, tweeted that Canada's turning its back on innovation, but the damage was already done. Tesla, once a symbol of the North American EV revolution, now found itself locked out of one of the continent's most promising and environmentally progressive markets. In a landmark decision, BRICS nations, comprising Brazil, Russia, India, China, and South Africa, agreed to purchase Canadian oil and gas using their own currencies, including the yuan and rupees, as well as gold. This move challenged the long-standing dominance of the US dollar in global energy transactions. In retaliation, President Trump imposed 150% tariffs on goods from BRICS countries, triggering widespread market instability. The US dollar weakened, the euro gained strength, and investors scrambled to adjust to the rapidly changing economic landscape. The global energy map has been redrawn, with Canada emerging as a key supplier to Asia and Europe, effectively bypassing the United States. The consequences for America are profound: increased risk of a prolonged recession, escalating energy costs, decline in industrial competitiveness. This transformation isn't solely about pipelines or tariffs. It's about a fundamental shift in power. The United States, once at the center of global energy and economic systems, now faces the challenge of adapting to a world where its influence is no longer assured. What are your thoughts on this evolving situation? Could such a scenario truly unfold? Share your opinions below. For more in-depth analysis and updates on global energy dynamics, subscribe now. The energy war is far from over. It's just beginning.